Stop. Whatever you're doing right now, stop it. Close the other tabs. Put down your phone. Because what I'm about to show you is not a theory. It's not speculation. It's not another false alarm. This morning, 4 major banks quietly stopped trading silver. Not because computers crashed, not because of scheduled maintenance. They stopped because they cannot play this game anymore. Look at your screen right now. What does silver price show? Maybe $71 or $72. That number is about to become meaningless. While you were sleeping, while you were scrolling through social media, something cracked inside the paper silver market. The crack is so deep that the biggest players just grabbed their money and walked away from the table. I'm going to show you the trading data. I'm going to walk you through the timeline. And I'm going to explain why this quiet event, this story that mainstream news will ignore, is the biggest warning signal in the silver market in 40 years. But here's what you must understand before we go deeper. These banks did not stop because they think silver will fall. They stopped because they are terrified. They stopped because the math finally broke. They stopped because continuing to trade would expose them to losses so massive that their risk departments said one word: enough. The dominoes are falling right now, and most people have no idea. If this channel has ever helped you see what others miss, hit that subscribe button right now. Tap the like button to help more people find this story. And please watch until the very end, because the final piece of evidence will change how you see this entire market. Let's begin. The morning started like any other trading day. Silver futures opened steady, volume looked normal, nothing suggested what was about to happen next. Then at 6:47 a.m. Eastern Time, something very strange occurred. 4 major banks, all at the same moment, stopped making trades in silver. These were not small players. These were the banks that handle most COMEX silver trades every single day. No warning came before this. No official news explained it. The trading screens just went quiet. Think of it like 4 major highways closing at the exact same moment. No accident reported. No construction announced. Just sudden and complete shutdown. Traders watching their screens saw bids disappear. Offers vanished into thin air. The market that moves millions of ounces daily simply froze in place. This was not a technical glitch. All 4 banks operate separate systems in different locations. The chance of simultaneous random failure is nearly zero. The last time something like this happened was back in 2008. Days before Bear Stearns collapsed, several major banks quietly pulled back from certain trades. They knew something others did not. They protected themselves first. So the question now hangs heavy. What do these 4 banks know today that we do not? Their silence is the loudest signal. When institutions that profit from every single trade suddenly refuse to trade, they are sending a clear message. They see danger that the public cannot yet see. The COMEX trading floor depends on these banks for stability. They provide the liquidity that keeps prices moving smoothly. Without them, the system becomes fragile, like a bridge missing its main supports. And this morning, those supports stepped away without a word. To understand why these banks stopped trading, we must look at what COMEX silver really is. Most people believe they are buying real metal. They are not. They are buying paper promises. For every single ounce of physical silver sitting in the COMEX vaults, roughly 400 ounces exist as paper contracts. This ratio sounds impossible. That is because it operates on one simple assumption. Almost nobody will ask for real metal. Picture a hotel with 100 rooms selling 400 reservations for the same night. The system works only if most guests cancel. But what happens when everyone shows up at once? This paper game has worked for decades. In 1974, when COMEX started silver futures, the ratio sat near 20-1. It was still risky, but manageable. Today, the leverage has grown beyond anything the system was designed to handle. Recent data shows something troubling. The registered silver in COMEX vaults, metal actually available for delivery, has fallen to historic lows. Meanwhile, open interest in futures contracts keeps climbing higher. These 2 lines are moving in opposite directions. One represents real metal, the other represents promises. The gap between them grows wider each week. Banks understand this math better than anyone. They built this system. They know exactly when the stress becomes too great. Their sudden retreat from trading suggests they see the breaking point approaching. The question that haunts traders now is simple but frightening. Did something happen in recent days that finally pushed this leverage beyond safe limits? Did delivery demand suddenly spike beyond what vaults can handle? The next piece of evidence points directly toward that answer. When traders buy COMEX silver futures, they have a choice at contract end. They can settle in cash or demand physical metal. For years, almost everyone took the cash. That pattern has now shattered. Recent weeks have seen an unusual surge in standing for delivery. This means traders are refusing cash. They want real silver placed in their hands. The numbers are alarming. Delivery demands have jumped to levels not seen since the 2020 pandemic panic. But here is where the data turns hostile. COMEX vaults currently hold roughly 30 million ounces of registered silver. Registered means metal actually tagged and ready for delivery. The recent delivery demands already claim most of the supply. Imagine a bank where depositors suddenly want their money back, all at the same time. The bank holds some cash, but nowhere near enough for everyone. This situation has a name. It is called a run. Back in March 2020, delivery demands spiked so hard that COMEX had to fly emergency silver supplies from London. Planes carried metal across the Atlantic just to prevent contract failures. That was a warning shot. This time, the pressure looks even greater. The strange part is who stands behind these delivery demands. Normally, industrial users request physical metal. They need silver for electronics and solar panels. But current data suggests large financial players are also demanding delivery. Entities that previously never touched physical metal now want it badly. Why would financial institutions suddenly want real silver instead of cash settlement? What do they know about the paper market that makes them distrust it? The banks that stopped trading this morning likely see the same troubling answer. History does not repeat perfectly, but it often rhymes. The silver market has broken before under similar stress. Each time, powerful interests change the rules to protect themselves. January 1980 stands as the most dramatic example. Silver prices rocketed from $11 to $50 in just weeks. The Hunt brothers had cornered massive amounts of physical metal. COMEX faced a serious problem. Too many delivery demands. Not enough silver to fulfill them all. The response came swiftly. COMEX changed trading rules midstream. They restricted position sizes. They raised margin requirements to crushing levels. Trading became liquidation only, meaning you could sell but not buy. The market collapsed within days. The Hunt brothers lost billions. Then came 2011. Silver climbed from $18 to nearly $50 again. Once more, delivery pressure built dangerously. Once more, exchanges intervened. They raised margins 5 times in just 8 days. Prices plunged 30% in 72 hours. Notice the pattern. When physical demand threatens the paper system, authorities do not let the system fail. They change the rules to stop the pressure. They protect the structure even if it means crushing legitimate traders. This morning's bank withdrawals carry the same warning signals. 4 institutions backing away simultaneously suggests they expect intervention soon. Perhaps they received quiet guidance. Perhaps they simply read the pattern from history. The 1980 and 2011 episodes both started with delivery stress. Both ended with emergency rule changes. Both protected banks at the expense of ordinary traders. If history follows its rhythm again, some form of intervention may already be planned. The silence from regulators becomes more suspicious when viewed through this lens. When major financial disruptions occur, regulators typically respond quickly. They issue statements. They calm markets. They explain what happened and promise oversight. This morning brought none of that. The Commodity Futures Trading Commission oversees COMEX. Their job includes monitoring market integrity and protecting traders. Yet hours after 4 major banks stopped silver trading, the CFTC remains completely silent. No press release, no emergency meeting announced, nothing. The CME group that operates COMEX has also said nothing. Their website shows no alerts. Their officials have given no interviews. It is as if this morning's events simply did not happen. This silence creates a dangerous information vacuum. Traders hold positions worth billions of dollars. They deserve to know if counterparty risks suddenly increased. They need clarity about whether their contracts remain valid and enforceable. Regulatory silence in moments of market stress usually means one of 2 things. Either authorities see no real problem worth addressing, or they see a problem so serious that public discussion might trigger panic. Given the historical patterns and delivery pressures already documented, the first option seems unlikely. That leaves the second possibility hanging like storm clouds. Think of it like airport officials saying nothing while multiple planes get grounded simultaneously. Their silence does not suggest everything is fine. It suggests something too complicated or dangerous to explain publicly yet. Back in 2008, regulators stayed quiet for crucial days while Bear Stearns collapsed. They worked behind closed doors on emergency measures. The public learned details only after deals were already made. Is similar backroom coordination happening right now around COMEX Silver? Are banks and regulators negotiating terms to prevent a larger breakdown? The absence of official explanation feels deliberate and calculated. Markets sometimes reveal secrets through unusual trading patterns. When insiders know something important before the public does, their fingerprints appear in the data. The 72 hours before this morning's bank halt show exactly these kinds of fingerprints. Options activity on silver turned sharply unusual 3 days ago. Put options, bets that prices will fall, spiked to volumes rarely seen outside major crisis moments. Someone was betting heavily on silver dropping hard and fast. Even stranger, several large institutional positions quietly exited during this same window. These were not normal profit-taking moves. These were full departures from positions held for months. The speed and size suggest urgent motivation. Think of party guests suddenly leaving before midnight without explanation. They know something about what happens next. They are protecting themselves based on information others lack. Trading volume data shows another irregularity. Dark pool transactions, private trades not visible on public exchanges, jumped significantly in the days leading up to the halt. These hidden trades let big players move positions without alerting the broader market. This pattern has precedent. Before Lehman Brothers announced bankruptcy in 2008, unusual options activity appeared days earlier. Insiders positioned themselves while public investors remained unaware. By the time news broke officially, the smart money had already moved. The timeline here raises uncomfortable questions. Did certain institutions receive advance warning about delivery problems or coming rule changes? Did they exit silver exposure while smaller traders stayed exposed? Financial laws prohibit trading on non-public material information, but proving insider knowledge requires documentation that rarely surfaces until investigations happen years later. Right now, the evidence sits in trading records. The patterns are visible. The question is whether anyone will investigate what these patterns reveal. The entire COMEX system rests on one fragile foundation: trust. Traders must believe that paper contracts represent real metal. They must trust that delivery promises will be honored. When that trust breaks, the consequences spread far beyond silver markets. If confidence collapses in COMEX silver, traders holding contracts face an impossible choice. They can demand physical delivery and risk contract failures, or they can accept cash settlement at prices they did not agree to. Either outcome destroys the fundamental purpose of futures markets. The broader financial system carries deep connections to these contracts. Banks hold silver positions as hedges against other trades. Investment funds use silver futures for portfolio balance. Industrial companies depend on COMEX prices for supply contracts months in advance. Think of it like discovering the town's water supply comes from an empty reservoir. Every business, every household, every plan built around that water suddenly faces crisis. Alternatives exist, but not at the scale needed. Physical silver markets would likely surge if COMEX credibility fails. Premiums on real metal already trade well above paper prices in some markets. That gap could explode wider, but physical markets lack the volume to absorb demand from broken futures contracts. History shows that authorities will intervene before allowing complete system failure, but intervention means rule changes. And rule changes mean some traders will be forced to absorb losses to protect the structure. This morning's bank withdrawals suggest that moment of choice may be approaching. 4 institutions decided their exposure carried too much risk. They stepped back from the table before the cards turned against them. The question now is whether others will follow and how quickly. The evidence from this morning paints a clear picture when viewed as a whole. 4 banks stopped trading silver at the exact same moment. Delivery demands have reached levels the vault system cannot easily support. The leverage ratio between paper and physical metal sits at historic extremes. Regulatory authorities remain mysteriously silent. And unusual trading patterns suggest certain players knew something was coming. None of these signals alone proves systemic failure, but together they form a pattern that has appeared before major market disruptions. The 1980 silver crisis, the 2008 financial collapse, the 2011 margin spike. Each time, small warning signs preceded larger breakdowns. What makes this moment especially concerning is the silence. When markets face technical problems, explanations come quickly. When markets face structural problems that authorities cannot easily fix, silence fills the void while solutions get negotiated behind closed doors. The 4 banks that stepped away this morning made a calculated decision. They saw risk that outweighed potential profit. They chose protection over participation. That choice tells us more than any official statement could. Whether this leads to full market failure or simply another round of emergency rule changes remains unknown, but the trajectory is clear. The gap between paper promises and physical reality has grown too wide. Something must give. The correction may come through price. It may come through regulation. It may come through contract modifications that favor institutions over individual traders. What seems certain is that the COMEX silver market operating today will not be the same market operating tomorrow. The evidence has become impossible to ignore.